Afternoon, everyone. Welcome to the Hedge News Operational Panel discussion. I'm Justice May, and I'll be serving as the moderator for this online event. I'm going to introduce the panelists shortly, but I'd just like to draw your attention to our online raffle that we'll be holding, where you can win a case of Prescient wine. And just to give you some background, Prescient is the proud sponsor of the Wine Mags Awards for the second year in a row. There's an annual Wine Mag report, which represents 14 categories of wines, all South African, looking for the best wines in each category. Then usually about 60 to 100 entries per category. And yeah, they basically rate the highest of each of these 14 categories. And they'll be announced at an award show, which will be held in November. Co-sponsored by Prescient, and also there'll be a tasting session in Johannesburg and London if COVID allows it. So yeah, there'll be a link towards the end of this discussion, so please click on it and you can actually win a nice case of wine. Okay, on to the panelists. So I'd like to welcome them all. So we have Andrew Cairns, Theana Neveling, and Gus Lowe. Almost a year ago to the day that we went into sort of hard lockdown, COVID-19, and all the rest of it. Markets crashed, etc. What do you think the operational impacts have been, and to sudden lockdown, working from home, etc. You as a Manco sort of faced various touch points, different service providers, etc. So what has your experiences been?
Yeah, it's been quite a year. March 2020 was not for the faint-hearted. But I am incredibly proud of how the industry and the country as a whole basically, was able to successfully migrate to the work from home literally overnight, which shows you that the technology has always been there, just the incentive to use it was not. But the hedge fund industry specifically is always run on an outsourced model. There's different counterparties at all different locations. So in some ways, in my experience, it wasn't such a huge upset. And also because, I think initially, just, not being able to phone the people you normally want to speak to sort out something quickly. But then Teams and Zoom changed our lives. And in some ways, at some point around June, I feel like I'm over communicating, like you're talking to too many people in a day. But it did change operationally it changed. What it changed for me was the fact that it felt like you could solve problems quicker. You get different people in a Zoom call or a Teams call and things just get sorted. Where before it would entail, everybody getting to the same place, having a meeting, and it takes 3 weeks to set it up. And also from a internal perspective, I do feel that, the team is more connected because now you kind of have a more structured way to your day. And I feel like we've solved, even though we did have a lot of issues that was, some as a result of COVID, some is just, maybe like things were a little bit more amped in the beginning. We kind of come out of it or busy with a process where we communicate better, we've got structured time, we actually get to problems quicker, we resolve things quicker, and it just feels everybody is more connected. So from an operational perspective, I actually think COVID has been great. It's literally, for me, it feels like it made us operationally more efficient in terms of time and resources and just thinking about things better, communicating better.
Yeah.
And from your side, from the administrator side.
No, 100%. Just talking about those efficiencies, like going paperless on simple things like checklists and things like that, which we should have probably done before, but it's actually just now forced us into this way of doing things, and it's actually proven to make us more efficient. It's actually, a lot of things have been better as a result. So, when it started, we were scared of, what is a hard lockdown actually mean? Nobody really knew. Like, would we be able to work at all? How's it all going to work? And then it was obviously running around, getting everything set up, making sure it worked. And then, the impact was not that bad in the end. We started it right on the point of year end with audits starting, distributions, all that kind of stuff that,
It happened at the worst possible time, and we survived it.
And we survived it, yeah. So it's actually amazing how everyone's come together. And that's, looking at prime brokers, all the sort of service providers, all the things that need to go into a NAV. And we didn't have any major delays or issues that actually stand out for me. So I think it was actually remarkable how everyone came together.
Yeah, it is testament to, the people in the industry. I mean, I think we all just, know each other, we trust each other, we respect each other, and we've always worked well together. And I think that collaboration just, got even stronger, when we were faced with this huge unknown.
Yeah, now you have to just balance the sort of work-life thing because you're basically on call 24/7.
You almost need to bring it back.
Exactly.
And nobody apologizes anymore if they phone you at after 6 at night.
No, just, get it done.
Yeah, I don't know if it will ever go back 100% like it used to. I think the productivity increases. People not wasting potentially 2 hours a day in traffic.
I mean, you do miss the office banter, that sort of thing, and maybe a bit of interaction with, physically with people, but I think there are other advantages as well. So, those due diligences that you always have, and there's always the question of disaster recovery and what are your plans.
Have you tested your disaster recovery plan?
Yeah,
I was laughing when somebody asked me that in June. I said, every day.
This is what it is. So
it's forced you to think about how to do things better.
We have proven as an industry that we can keep going, and that's actually worked out enormously well.
My hope is that, all this almost renewed energy can help us propel the industry forward and, make it grow the hedge fund industry even bigger than it is, because I think it's got huge untapped potential. We've got amazing hedge fund infrastructure. We've got amazing investment managers.
Quite in detail, but basically a BN52 version 2 wish list. So sort of what changes are needed to facilitate growth in investment, including regulatory and operational changes that make a practical difference. And maybe we start with Diana on this one.
Quantitative 52 version 2 is still a long way off. But I do think that there are definitely some items that we can ask for enhancements. Definitely, I think, especially on the risk management, I think there's a lot of areas where clarification are needed. I'm thinking specifically of how to calculate VAR. I think some specific guidance would be appreciated so that we can calculate VAR in a comparable manner. And Gus, I'm sure you also have lots to say about the VAR calculation.
Strong opinion.
Yeah, I agree with you. I think, we're all hoping for version 2. We don't know how long it's going to be, but we can still say what we want in it. And from our side, obviously, yes, a lot of the stuff we encounter, we have to translate legal speak into actual numbers, right? And clarity is sometimes very tough to find, or it's ambiguous because it's a legal document, not a technical document. And so, yeah, from our side and from the confusion that we sometimes get, you can have interpretations both ways and have a compelling case, and any guidance on specific technical calculations. You mentioned VAR. It is something that we'd like to have clarity on. I think specifically, if you look where BN52 had its roots from, obviously large parts of it comes from UCITS. And if you then look at UCITS and you see the detail they go into to give you guidance on how some of the calculations should be performed, those things are not in our documentation or in our legislation. So, yeah, I mean, I can go on and on. It's a favorite party topic of mine. But VAR, like you say, they have some high-level checks in it, but we only, for example, in our regs have a absolute VAR. And it touches a bit on, I think, possibly some of the topics we might touch on later is how to make hedge funds more investable and understandable, therefore, to people selling it and potential investors is include something which is in use, it's relative VAR. That would be really nice if they can include that. I don't want to get too technical on it. But in summary, there's, from our side, clarification or guidance or implementation notes would really go a long way in removing areas where there's confusion currently.
So I think for Board Notice 52 needs to have a grounding in or try and make changes which precipitate growth. We've had an industry which hasn't grown particularly in the last 5 years, and that's and certainly not grown in line with our expectations around bringing in regulation. So, you know, if the regulatory bodies could take a deeper dive, consult with industry and with the entire value chain to see what can be done to precipitate growth and see what can be changed to enhance knowledge around hedge funds as an alternative. So I think we've got a long way as an industry to get to actually provide a sort of collaborative platform, get closer to the regulator, and find a common ground where we can actually see some decent growth in the industry.
Reporting requirements that was taken from the unregulated space, specifically the detailed P&L reporting, that made sense when the unregulated funds were in partnerships. But most regulated funds are in CIS trusts, and that level of reporting is actually providing investors with incorrect information. And on countless occasions, I realized that investors are recording those recording the P&L information, and that's not actually the income that they're earning. They're only earning dividends and interest, and should only record income from distribution statements. So there are a lot of things in that regulation that is forcing, incorrect disclosure, I think, on the parts of mancos.
Most mancos don't actually report those NAV breakdown statements as such, because the income is only at the distribution point. So that NAV breakdown, as you say, is basically not useful information. It's not accurate.
I think on also in general, so there's some of the reporting requirements, and I think it is something we might touch on if we have time, is barriers to entry, and it is super onerous, some of the reporting. Obviously, we are contracted sometimes to do that for that, but you sometimes wonder if there can be some streamlining that you can do to these. But we'll settle for clarification of definitions and implementations before streamlining.
I think less is more at this point.
Yeah. Yeah. Definitely, but it's what do you take out and why do you take it out? You have to really be understanding of what you're getting, and maybe the current approach of having so many reports is to just cover all the bases, which is unnecessary in a lot of cases, but hopefully that's the next evolution. So borrow more from UCITS. It's fine to do that. They've tried and tested it, right? So we should take that and incorporate it a lot more.
Thanks. And something that I want to touch on, maybe that Andrew sort of alluded to, is there a need for a sort of new industry body, perhaps? I know it's been discussed, aim a sort of South African chapter. What are your guys' opinion on that? Maybe start with you, Thiana.
Well, I mean, I'd look at the private equity industry, and I think that SAFCA has done amazing to grow the industry. And you can't help to wonder, what would it take for the hedge fund industry to break through 100 billion? I mean, the private equity industry, to my knowledge, is 3-4 times bigger than the hedge fund industry. And I do think that, an organization like a CISA is incredibly helpful to assist the industry with regulatory mediation or consultation with the regulator, and maybe more industry-wide issues. But I do think that the hedge fund industry itself, I mean, a CISA can't really educate investors and market. They've got a whole lot of industry segments to look after. And I think the hedge fund industry must take it upon themselves to say, if we want to grow this industry, we want to go forward, and, we need to seriously consider having our own industry body that would go to pension fund trustees, educate them, explain to them, the things that might confuse them or scare them about hedge funds, demystify hedge funds for them and explain to them. And, as a banker and from administrators, we can market the fact that we are a very well-regulated industry. We were well-regulated when we were self-regulated. And we've continued that and just enhanced that. And these risk service providers in the industry, these independent administrators. I mean, in my mind, that's, the government structure is very sound. And we need to put it out there to the broader retail market who, are just scared of hedge funds.
Yeah, I think there's a distinct need for education around the use of hedge funds in a portfolio and the diversification it brings. Too many people think, I'm investing in a hedge fund because, I'm looking for some sort of racy return. It really isn't that. It really needs to be marketed as an alternative that everybody should have in their portfolios to enhance the diversification of both product and return. So I think you're right. There's a lot of education to do, and I think an industry body will go a long way in achieving that, provided it has the right objectives and seeks the right outcomes.
I think look, I'm not, the CISA that they do, as Iona says, they do a good job, but also sometimes when you see in the hedge fund industry, between the different levels, there is almost like a informal connection. People discuss things amongst mancos and people know each other. It's quite small in that sense. So having a body maybe just almost formalizing discussions would be good. In a sense, it's sometimes like compliance by consensus. But if you're unclear on certain parts, what you do is you ask the other guys, how do you guys see this, right? You also interpret it this way, and it'll be informal but informative. And maybe having a body like that will just elevate it to a bit more formal stage, which can maybe have contact with the FSCA or the people who actually can make changes higher up easier.
I mean, at the start of the regulated journey, the mancos that have an informal forum where just to debate and discuss, a lot of the regulation, like because it wasn't very clear. And at that point, I think the regulator wasn't even sure exactly what they wanted. And that was extremely helpful. And you feel like, there's a lot of that can be done. If we could achieve that on an admin level, I mean, definitely will be worth our while to explore, if the whole ecosystem gets involved, where we can take this industry.
And who drives that? Who sets that up, or how does it happen?
Well, I mean, I would think that you need to either start or establish a separate entity. I think it would be helpful to start it off with buy-in and some sort of seeding capital from the bigger players on the market, and then take it from there. I mean, I think the main mandate should be marketing, education. I mean, the items that are actually going to grow the industry. And then, I mean, like Andrew said, you're going to have to be very clear, and I think it has to be a very narrow mandate initially, and keep it, and it has got to be funded from the industry. I mean, SAFCA is a very well-funded industry body, but it's really served the power industry extremely well. I mean, the Reg 28 has just given them additional 5% allocation.
Yeah, I think it needs very motivated individuals with the right support from the industry. So that I think is the cornerstone. And then, small successes will build on themselves. So, I think if they get some decent momentum, then it grows into what is the equivalent of a SAFCA or an AIMA. Those are two bodies which are well regarded, and they certainly act in the best interest of their respective industries, and get great results. So I think that should be, the start. Find motivated individuals with good support from the industry, and then see where that takes us.
Just one other topic, maybe for Theana, is just recent amendments to Regulation 28. Do you have any views on that? Hedge funds now don't essentially have to share their portion of the pot with the private equity funds. Do you think this is going to have any impact, or none at all, or just something nice to have, essentially?
Well, I think the Reg 28 amendments is more to facilitate or infrastructure investments, because I think a lot of the infrastructure investors may probably come to private equity funds. I don't think any of those amendments were made with the hedge fund industry in mind. It's still the same 10% and 2.5% single strat fund and 5% maximum to a fund of hedge funds. I don't really think it will impact the hedge funds. What will impact the hedge fund industry is the appetite by the retirement fund industry to invest. The actual limit that they allowed, because I think once the retirement industry starts, investing in the hedge funds as part of a, well thought out portfolio construction process, and start seeing the benefits from that, then only will there will be a demand to say, okay, we would like our hedge fund allocation to be moved up. But there's no demand from them, and the FSCA or the regulator is not going to do anything in that regard.
On to the next topic, sort of recent thing that's happened, and maybe we can talk about it from a sort of Manco risk and prime broker type of point of view, is the Robinhood and GameStop saga. Do you think this is a cause for concern in the local market? Is it going to be viewed as some sort of market manipulation? Should it be regulated, this kind of thing? What are your views? Maybe Gus can kick us off.
I don't know. I think it's fantastic what happened. Even being someone who has to look after risk sometimes, I think it's an inevitable thing of it's our future. The market is much more accessible. People, while they're in their Uber, can trade stocks through their mobile, and it is now a truly public traded market. It was nothing other than a short squeeze, and short squeezes happen, and usually when they happen, they're very painful. But to blame it on a Reddit forum or on anything like that, or to try and regulate it, would be a fool's errand. I don't think it should be a warning. If you like shorting stocks, you obviously have to make sure that you have cover, that you have ample script, and recall risk is the minimum. If you're a derivative provider or one of the people who provide it through their platform, perhaps you have to be more mindful of this. How close it is to happening in South Africa, it's tough to say. We're always quite far behind, but the connectivity and the access for the man on the street is going to come, and it's like I say, it's going to be here, and it's not going to go away. And I don't think you're going to regulate it.
I disagree with Gus. I think platforms like Reddit, I mean, they've got a well-documented and very negative tone towards regulated financial services, especially hedge funds. I mean, you look at the website, it looks like a Facebook page with all sorts of random posts and pictures about, my next hedge fund advice, and then, all sorts of, yeah. But I mean, in my mind, I think if it was just about accessibility, so let's, equate it to something like an application that allows small business to lend very efficiently and quickly. But it's not that. In my mind, it's kind of you weaponizing social media and using people who don't really know any better to basically attain a preset goal. I mean, by somebody that engineered it. I mean, social engineering is there. It's documented. The American elections is possibly an example of that. But the thing is, I do think it's something to be aware of. And I think that it can easily happen, yeah. The question is whether it happened. I think some people would like to play it out or to paint it as that this was just, because of a large leveraged short position. But what prevents these platforms to do something similar like Viceroy tried to do at Capitec, where they enable their followers to short shares that, there's no valid reason, there's no research, there's nothing to support that directive, basically. And what I find very sad is that these investors that just follow these suggestions or more like instructions from these platforms. They're the very type of investors that all the regulation aim to protect. They're uninformed retail investors that don't know any better, that all, have no idea whether they actually, they're gambling. This is, I don't know, in my mind, the same as gambling. And I think, from a regulated perspective, you need to think about these things. I think they are using the established risk management principles that an industry like the hedge fund industry uses, like stop losses and, deleveraging at certain points. They're just using against them. And you have to wonder that if you are faced with this, as a mango, I would like to think that, we need to do whatever is necessary to best protect the investors in the regulated hedge funds. Should you then force a manager to close out a position, realize a loss, and provided that, obviously that position must be within limits and regulations to start off with. But if something happens that is completely random, that could be, that's caused by one of these platforms, should you then not just allow a temporary mandate breach until the storm passes and not realize that completely manipulated loss to realize? And, that, I guess, would take a lot of subjective decision making. But I mean, the rest of the mankers are tasked with doing risk management and making those decisions and making sure that investors are protected at all times.
Yeah, I think the tough predicament for the manco there would be, you're damned if you do and you're damned if you don't. So, my sense is that you'd probably want to take a conservative decision on that, cut those positions early, but it's very tough. And then you asked Justice around a prime broker view. We would monitor that very closely, both from a short interest perspective and the borrower and the ability to borrow. And typically, a client would need to come to us to find borrow. So that's a constant dialogue that we have with guys when there are positions that are being short squeezed and there are limitations in terms of borrow in the market. It is difficult and needs to be managed very actively, and we monitor those situations very closely. And then I think the rational mind says, sense will prevail and things will return to normal. But in the moment, as a prime broker, you've got to assist essentially the mancos to protect their fiduciary and regulatory obligations. And my sense would be, you'd have to force them to cut those positions.
No, I mean, again, I agree with. There should be no regulation to try and curb this. It must be common sense, or the role of, in this case, probably mancos, who have the tools to do this. You stop disinvestments, because your risk is that if you allow the manager to keep the position because you think it's a flash mob through a social media platform, that's one thing, but investors will try and get out. And then the manager will have no choice but to actually realize the loss. So it has to go with gating redemptions to stop that. But that's tools that bankers have. I think to a degree, blaming social media, I don't like social media. I think it's useless, but I'm too old to have a comment that's worthwhile in that space. But to blame social media for this, you should probably say, well, maybe these sophisticated investors who lost so much money, their checks in terms of how much of a position in terms of the outstanding free float stock they had, was that acceptable risks to take? I mean, something similar happened with the short squeeze on Volkswagen. And there the principal who pushed it wasn't social media, it was Porsche. And they also made an announcement to push it their way. And they did it through a formal, like a sense announcement. It wasn't through social media, but the same carnage happened. And if you go look at the aftermath of that, they tried, every hedge fund manager or manco that lost money tried to take them to court, and they were all dismissed. So I think it's an interesting development, something I'll be watching from a distance, because I don't care for social media too much. But it is a new dawn, and it's going to up the stakes for the role players like ourselves, like mancos, like the risk providers, or the guys who give the derivatives, like Andrew's team, and that you must be aware of. This is not going to go away, in our opinion, and it's not going to be regulated.
Do you think that this will just be maybe something that happens around large short positions? And then it begs the question, I mean, I guess overseas, I mean, there are companies like, I think, Citron, who publishes reports on, large short positions. But to my mind, I mean, nobody should know. There's confidentiality around people's positions. I mean, large short positions. If a platform like that would to get information, then that would be a breach of confidentiality somewhere.
Sorry, we would definitely not share any short positions in terms of granularity around who wanting to short, but managers do come to us to source borrow. So we will naturally be a place to whereby managers would be an information point, one of the primary information points, because as one of our primary functions is securing borrow to be able to short. So we would typically know when a client is building wanting to build a short position, but we certainly wouldn't disclose it to anybody.
I think some of the information is not necessarily leaked or that, but I mean, part of how platforms like Robinhood function and can offer free trading is that they sell the individual user's trading activity to people like the hedge funds that got hurt. I think there's a bit of irony in that. But and I mean, on Bloomberg, there's a term for that, like a social velocity indicator. So there's like algorithms that check how frequently stocks are mentioned in social media to try and gauge the momentum behind them. So these are there, right? And some of this information is, if you call it, scraped from public information, from the people who use these free trading platforms. If it's free, usually you are the product.
Yeah.
And there has to be a nice irony in this whole story somewhere.
And the FSCA did bring out a discussion paper, I think, around November 2018 about, reporting, short sale reporting disclosures. But I don't, to my mind, there's nothing come of it again. But that could also be a source of information to platforms that could use that information vindictively.
And there was also that tale of this collective trading up on a ticker that I think, Diana, did you tell me that story? And it was the wrong ticker, and then they drove up the price of a mining company or something like that.
Yeah, I think they just gave the ticker on one of these chat lines, and then some people got it wrong, and then they used, I can't remember, 3 digits instead of 4 the other way around. And then overnight, this peripheral mining company in Australia's share price doubled, and they had no idea. It tells you again that the nature of these investors, on these platforms, there's no substitute for proper research and, building an investment case. And then, for retail investors that can't do that, you pay professional investment managers. That's what the asset management industry is all about. But in this case, I saw an interview with the guy from Reddit, what is it, Keith Gill, where he seems to think that social media platforms is the ultimate equalizer to hedge fund analyst teams. And it's just a bizarre statement to make.
Battle lines are drawn. I really think it's you need that. In a market, you need people with opposing views, right? Otherwise, there's no opportunities. So you either got to, man up and get used to it and see the opportunity. And this where day traders, they're nothing but gamblers, right? But they're allowed to. It's their choice. But they offer opportunities to people who have an opposing view built on an investment thesis with a longer investment horizon to say, cool, I'll buy those or whatever, right? So I'm watching this with from a distance in terms of what the social media are up to, but it's going to be CDs and MP3s were in the music industry. It's going to happen, and it's not going to go away.
Yeah, I think what you'll find is very few of those guys who followed it actually made money in the end. So those few that maybe initiated it with the intent of making money probably made bombs, but the majority of those that followed that trade probably lost money in the end.
What are the concerns around rehypothecation, and does rehypothecation of assets make the industry efficient?
Well, rehypothecation is a concern in collateral arrangements, specifically where scrip collateral is provided for scrip borrowing. And this is basically done through outright transfer of ownership of the shares with the scrip borrowing. And from a Manco perspective and from a protecting investors, ideally, we prefer a session or pledge, which is the alternative, which is much easier to do these days with the statutory flagging system that Straight provides. But I do understand that rehypothecation is a possibility now more than it was before because of the STT change, and now the outright transfer is not deemed to be a tax event anymore. And it does provide possibilities for lowering the cost of borrowing. I think the issue for me with rehypothecation is that when your assets are rehypothecated, so you give it to your counterparty, you take on additional counterparty risk, and the risk is that counterparty can on-transfer those shares to other counterparties that you don't have sight of. And that's essentially, what happened with Lehman Brothers, where, people who had broking accounts because Lehman rehypothecated their shares, nobody knew where they were anymore. And where you once held scrip that you've provided as collateral, you now only owned a right, and that just made you a concurrent creditor to your counterparty. I think there must be some sort of middle ground. I think that possibly you can allow rehypothecation if you can contractually maybe limit the level at which you can do rehypothecation. So to say that, okay, fine, I'll give my scrip as collateral for the scripting or scrip borrowing arrangements that we enter into, but you can only rehypothecate it up one level. So and it is a proper tracking system. So similar to the statutory flagging, to know, where are your assets actually held, so that if there is any insolvency events, that, it could be tracked and, maybe, hopefully, you can get your assets back. It is something that the regulator is concerned about. I do think that there are a lot of people in the industry that don't quite understand the risk involved and what rehypothecation, nobody thinks about worst case scenario, but worst case scenario happened. We're living it.
Yeah, so just say thank you for all the panelists. Thank you for attending, and for everyone watching, please remember to click on the link for that prescient wine raffle. And thanks everyone for joining.
Good day and welcome to all the viewers to this panel session of the 2021 Hedge News Africa Symposium. My name is Emlyn Flint and I will be moderating today's discussion on whether quantitative processes add value to the portfolio and risk management framework. I'm joined today by a very prestigious panel, a very experienced panel as well, and most of which I am sure will be very familiar to our audience. Ben Gudurski from SS&C Advent, Jean-Pierre Fister from Protea Capital Management, Rowan Williams from Nitrogen Fund Managers, and Nafiz Hussain from, at the moment, currently, APSA Alternative Asset Management. And I think today, just to contextualize the discussion first, what I'll do is just introduce the topic and the ideas, and then I'll hand over to the panel, who I'm sure you're wanting to listen to anyway. Now, just to start off, a single portfolio management process has multiple steps. So what we're looking at today is whether quantitative processes add value to the portfolio management framework. And we're dealing with things like initial data processing, valuation of assets, creating views, risk managing your portfolios, constructing your portfolios, executing your trades, attributing your return and risk, and monitoring both your portfolio and reporting of the trades at the same time. All of those are just in one portfolio management framework, right? At the same time, we have numerous quantitative processes, simple automation and data handling, fundamental valuation models, which is potentially something that one might call quantitative or qualitative, alpha factor modeling, risk modeling on the portfolio side, optimization routines for your portfolio construction processes, market microstructure, and trade execution, just to name a few. So clearly there's a lot to cover. We'll try our best to pick what's interesting. We're not going to try and cover the full gamut, otherwise I think we'd be the whole day. So what we're really going to look at is three nuanced versions of the questions. Where can quant processes add the most value? What are the risks involved in including quantitative processes, and particularly in light of what's happened in 2020, where we've had structural changes in the market? And how can one optimally combine quantitative and qualitative processes into a single framework? So to get the discussion rolling, I think I'll hand over probably to Rowan, I think, who's our most experienced panelist of the four. And just to start the discussion, Nitrogen clearly uses a lot of quantitative processes already in their setup. So just to get the ball rolling, I think, Rowan, where do you use quantitative processes mostly, and where do you think that you can get the most value from the quantitative processes that you currently include?
Yeah, Emlyn, as you rightly said, investment management is a combination of quantitative and qualitative processes. So it's quite broad in terms of, I guess, quantitative in the sort of more traditional sense, using certain statistical techniques or filtering type techniques that are sort of more mathematical in nature, I guess, to help guide the investment process and add value to the investment process. So we do see it as a valuable tool, and as you pointed out, it is a tool. It's part of your overall mix. And I think more and more, even so, 2020 has sort of brought it home to bear that a purely quantitative process that is ignoring sort of the context and the market environment can lead to difficulty and challenges. And I think that's what we've seen, that it's a constantly evolving process. So, and I guess the experience of 2020 did bring to us that it's more of a tool, and you do have to apply your mind at all times as an investment professional. Use those years of experience. I'm glad you didn't say I'm old, I'm just experienced. But use all of that to improve outcomes, I guess. And so where we use it is across a few factors or parts of the process. I think initially it's quite powerful as a filtering process. So it helps just take a lot of information, analyze it sort of using a set of rules or heuristics to give you ideas. And then it's important that you use your more qualitative or your experience hack, your more fundamental analysis to say the quantitative filtering is giving me an interesting idea, Is it something that's actually interesting, or is it just telling me something that the market already knows? Is this share relatively cheap, but the prospects are such that it's not indicating any relative value, relative to actual market expectations. And then also in the sort of execution process, we use it quite effectively. So that's at the point of execution when we're actually trading. So in a way that's sort of tactical. And then also in risk management, which I think we're also going to cover. So we see it as adding a lot of value, but it's important that it's incorporated into a holistic investment process. And as I said, 2020 was just sort of reminded us of that fact, more so maybe than in previous years.
No, definitely. I think 2020 is perhaps going to go down in history as a structural break or regime change at the very least, or to put it quite lightly. You made a couple of points there talking about using quantitative processes as rules-based techniques and heuristics. Jean-Pierre, maybe I'll pass over to yourself. I know you are a big proponent of what is now called the quantamental process, so maybe you can give us a bit more information on that side.
Sure, thanks, Emlyn. Yes, I agree with what Rowan has said in terms of combining quantitative and qualitative information and analysis tools, and that is what we do as well. What we've done is we've started the automation and the use of mathematical factors and algorithms on the fundamental side of data, rather than, I would say, many other quant funds that start with market data. So, for instance, what makes our process slightly different is we don't have price as an input to any of our processes or models. And traditionally, whether it's bid-offer spreads, momentum, or other indicators that use price, we started at the other end of the spectrum, seeing that we came from a fundamental type analysis background. So how we specifically use it is we've effectively automated the model building process to build a valuation model of an individual company. And we use algorithms, like I say, not on market data, but on fundamental data. So as an example, we can look at the past history of what each line item of the fundamentals of the company looks like, the published financials, and forecast that automatically using an algorithm. And in that way, build the next 4 years' financial statements automatically within 2 minutes. That might take an analyst 2 days. And that allows us then a lot of breadth because we can do more in less time. And historically, using that process, then we believe we can generate above average returns. We are constantly developing this process, though, to incorporate market-based data as well. For instance, if you analyze a gold mine or Sasol, you need to use some market data like the gold price or the oil price or the rand-dollar exchange rate. So where we started quite internally focused, we are now expanding the quantamental process to use external data as well. But like I say, when it comes to the portfolio management process, we combine this almost purely quantitative data with qualitative insights regarding a company. And we sometimes also override our data in terms of what the quant process says the future might look like. When we do feel that human judgment has got an important impact and we shouldn't just purely believe what the black box says. So that, in short, is what we do at Protea Capital Management. Thanks very much, Jean-Pierre. Your 2 minutes versus 2 days, I think, is quite an interesting topic, and it brings, I guess, quite nicely to the issue of the risks involved in following a quantitative process, which is effectively automating 2 days of analyst work where they might potentially be applying their minds. So let me just stay with you, and then Nafis, I think, has some views on the issue of dividend discount model, Gordon growth model being a fundamental or a quantitative process itself. So I'm sure he'll be able to add something after this. But what do you view here as the risk involved in effectively automating what previously would have been used? An analyst would have applied their mind and looked at for over 2 days in your 2 minutes. So the number one is speed. And because of that, you can do more in the same amount of time. And related to that is breadth. So if you're looking at the SA market, you might be looking at 200 stocks. That might be in 10 different sectors. So you either need to have 10 different industry specialists in terms of your analyst team to look at those. And it will take you a lot of time. As an investment management business, it increases your cost base because you're paying salaries to 10 analysts. And the automation of all this process, I think, makes for a better asset management business. And it gives you that speed and more breadth. And that's why we've developed now or expanded our universe to look at global stocks. So a lot of South African-based managers have started the last few years to look at global stocks. And I think the more one can automate and the more it gives you that breadth, the more successful potentially you could be when you look at global stocks and your universe goes from 200 stocks to 8,000 stocks. So that has been the main benefit that we've seen from this specific approach.
Okay, thanks. Nafis, do you want to add anything to that, particularly on the valuation modeling side?
Thanks for that, Emlyn. Thank you all. Yeah, look, I mean, at Absa Alternatives, we obviously explore a wide spectrum of asset classes in the alternative space. And so, we, like JP and Rowan have alluded to, we are very appreciative of both the quantamental framework, particularly qualitative and quantitative processes. On the hedge fund side, we are very highly focused on the quantitative side. So I think, we see it as a very big value add, given the amount of data that we do consume. To give you an idea, you're looking at the top 100 stocks. If you're looking at the relative value space and you want to look at all the combinations and permutations that you want to analyze there, from a statistical perspective, that's 4,950 relationships. And so, the processes and the frameworks that we've built up tries to analyze that and monitor that in a live setting in the space of 5 minutes. So similar to, not as quick as JP, but we'll get there with maybe parallel computing. But yeah, definitely we see a great deal of advantage for quants processes. And we're living in a world where you've got a tsunami of data that's coming at you from the internet, from social media, and so we've done quite a bit of work in the machine learning space and the AI space, and we've sort of started incorporating that into sort of asset classes like private debt, credit scoring models. So we see a great deal of benefit and a fine balance when using qualitative and quantamental processes together.
Okay, so I think quite clear agreements between the three. Nafis, you mentioned the tsunami of data, which I think is at the forefront of everyone's mind at the moment. Probably the sexiest career at the moment is a data scientist, and do one Coursera course with Python, and you've been promised to become a data scientist in 5 minutes. It's obviously not quite that simple. And Ben, I think I'll pass over to you. We have a lot of access to data. It requires a lot of technological skill or technical skill and expertise, and systems obviously play a massive role. Nafis was mentioning 5 minutes versus the 2 minutes in parallel computing. Where do you think the systems come in, and how much should we trust the computers to run the processes versus potentially the alternative of a more qualitative or fundamental approach?
Thanks, Emlyn. I think you're right. I think everyone's very aware that we're living in a data age now. Data is key throughout the market. I think people seem to think there's no such thing as too much data, but using that data correctly is more important. And I've done a few panels now on different subjects, and they always seem to come back to data being the key opportunity that you need. I was reading a very interesting article yesterday regarding alternative data. So rather than using, as JP was mentioning earlier, rather than using sort of price-based data, they're having like satellite footage of store car parks to see the footfall and how many cars are going to supermarkets. So to pad out your decision on whether to go with that stock or not. It's a very interesting space. Regarding do you trust the black box or not? To use a sports analogy, for me, it's very similar to TMO or VAR at the moment, in respect that when these systems were brought in, it was to remove human error and do things better. And after a year or so of doing that, it was suddenly realised that actually we're having just as many mistakes, but different mistakes because we're based on the machine. So bringing that qualitative, bringing that human aspect back into the process again, bringing that qualitative access back into the quantitative perspective is making and especially in regards to rugby rather than football at the moment, it's definitely making that process a better process by using the both together rather than relying on one or the other.
No, agreed. I think systems, quantitative and machine learning processes all go hand in hand, along with the data, which is the main ingredients. I think we've touched on a couple issues here, and I think we'll put a pin in some of them and come back to them a little bit later. But one I want to address now straight away is it's something that all four of you have effectively mentioned, is combining quantitative and qualitative processes. Now, I'm going to be try and be quite specific and ask. It's great to say that, but how do you actually do that in an optimal fashion? What is the best way of combining quantitative and qualitative processes? Quantamental is a great word. Augmented intelligence is a great word. Data-driven decision processes, they work well in marketing brochures, but what does it actually mean in practice? And I'll open it up to the floor. And if you have comments, you're welcome to add your thoughts.
Sorry, thanks, Rowan. So I can use a practical example because it's literally core to our process. Let's say, for instance, we run algorithms on a specific company, and it shows that the margins are going to keep on increasing and the profits are going to grow strongly for the next 4 years. But when we think about the company, the business model of the company, we might think that it has some advantage that will actually shrink in the next 4 years. The moat will narrow, as we say in the qualitative world or the fundamental world. And because of that, even though the model might indicate, as it extrapolates the past, that things are just going to get better, when we overlay that with a more fundamental qualitative human impact, we say maybe the machine isn't quite right to extrapolate the past. Maybe if we use human judgment, the moat doesn't widen but narrows. And therefore, what we then do is we would override what the black box says using our qualitative insight. I'll use one more quick example, and that is if we look at the past year, if you ran algorithms on a company's financial statements or even market data soon after the March drawdown of 2020, that might have been extrapolated further down by your quant process, while actually things reverted back to a long-term trend line. But even that is not also necessarily always the case. And you need to use human judgment to effectively know when are you dealing with a series that shows momentum or reversion to the mean rather, and when do you use a series that shows momentum, so going further and further and further from the mean. And those are two very different outcomes. And you need to use some human judgment, in our opinion, to decide which of the two is more appropriate.
Yeah, I would really sort of echo that and second that. Really, I guess a lot of these quantitative processes are modeling the past. So they're taking historic data and assuming that relationship that you've identified and model will continue into the future. And I guess that's where really you can add a lot of value. So as a base case, that may be correct, sort of a ceteris paribus, but every time the model tells you something, you need to apply your human judgment and say, is it the same as last time? Have conditions changed? As Jean-Pierre was saying, you know, are circumstances actually changing? Which the model, because it's a quantitative process, is unemotional, is just analyzing data and a time series of data and forecasting that forward based on what the model predicts, but things can be shifting and changing. And I think in particular, obviously, the COVID pandemic and the market's response to it is a big non-linear event. And initially sort of there was a significant sell-off, coupled then with a massive reflation of assets. So, and that a traditional model, a very sort of longer term, sort of less dynamic model, really didn't pick it up. And the guys that did particularly well were more the human type traders that could see that ultra low interest rates were actually going to reflate almost every risk asset known to man, no matter what your models were saying. And so they kind of possibly threw the models out the window or paid them much less heed than they would have in the past. So it's a constantly evolving process, and that's why it is quite dynamic. And I believe the sort of augmented intelligence is actually more important. These data analysis tools can help us condense and analyze a lot of information, but it is the human judgment that ultimately determines whether they add value or not. So that's the sort of combination that you're looking for.
Just to make the point, Jean-Pierre and Rowan, both of you are effectively saying run the quant processes first and then override at the end with your judgment if you need. Is that correct?
Yeah.
Okay, thanks. Nafis, go ahead.
Yeah, I mean, I think, just to leverage off the experience of the past year, it's been a regime that I guess financial markets have found themselves in a very unprecedented setting, right? You've got this fiscal stimulus of this balance sheet experiment of central banks happening in the backdrop, coupled with a pandemic. You'd have to go back really far in history to see that such a combination or regime is quite unique to what we're going through in financial markets today. And so, quite rightly, as both Jean-Pierre and Rowan have pointed out, we've built these systematic frameworks, and the algorithms definitely had a massive breakdown in relationships in such a setting. But it's really important that you've got an established framework to detach emotions from such an environment, because emotions run very high. And I think those are one of the massive advantages when you've done rigorous sort of testing and analyzing. And when you're moving into uncharted territory, it's using that and leveraging on the qualitative inner human sense to sort of make a judgment call to say, right, I'm in uncharted territory, there's a regime change over here, scale back the bets, bring down the risk. And, that through experience, and no matter how good the machines are, it comes out, with human touch and with having seen and making an intuitive decision. But yet still, and I guess leveraging off the framework of detaching emotions and being analytical in such an instance is where the real balance and combination are at their prime. So that for me was really the jewels of this whole past year that we've sort of leveraged on. And really the machine learning only gets better because the more data you have, particularly in a new regime, and as it evolves, the more new relationships that you have to sort of harvest and evolve with. So the evolution is also just as important as the past.
Okay, thanks, Nafis. Let me play a bit of devil's advocate, I guess, here, and just look at a couple of stats from last year. So this is from the Bank of America on US markets. The average equity mutual fund, +8. The average equity quant mutual fund, only +3 for 2020. The average hedge fund, +6. The average quant hedge fund, -6. So clearly a large disparity in what we would call quantitative processes, potentially maybe not looking at the qualitative aspects that you've been talking about here. But one would expect, there would be similarly bright people on the US markets, but receiving very, very different results. So Ben, maybe I'll pass to yourself, as being a systems provider who has a lot of exposure to global markets and global managers, why did what's the rationale? Why did quant strategies, or even quantitative plus qualitative strategies, just not perform in comparison to the rest of their competitors?
I'm sure there's a lot of very clever people out there trying to work that out, but I'll do my best. I think a lot of, as we've alluded to already, a lot of the more quantitative processes rely on historical data. And it relies on what's happened previously, and then it tries to apply it to what's going to happen in the future. I think the age-old example of LTCM was going very successfully until the Russian government defaulted on their debt, and suddenly they had to be assisted. So I think from that, I think COVID wasn't something that many people were typing into their risk engines. I think it was one of these things that did hit a lot of people out of nowhere. I think it was one of those things that it was more the unknown, unfortunately, rather than something that could be predicted. I mean, we see across the board of asset managers, so not just hedge funds, but we see everyone seems to be more of a diverse portfolio now. There's people, much as Nafees was referring to, it's more a case now about having a level of security, not going 100% in one particular type of funds, because I think people have learned from previous examples that it's high reward, but it's very big losses as well if it goes wrong. So private equity, we're seeing a lot more of that coming into people's portfolios now, almost as like the underlying stability to sort of negate any of the big risks that come with the big alphas.
Okay, thanks, Ben. I know I gave you a bit of a Hail Mary pass there to answer a very, very difficult question. I think it's a very good answer. And you touched on one point where you said, no one put COVID into their risk engines. One of the issues that we across all financial market practitioners globally is we generally use a lot of risk systems which are potentially off the shelf. You've got your large companies, your Barrows, your FactSets, Axiomas, which provide very, very large risk models. And one would think that in the risk management and modeling side, quantitative processes are a far better fit, perhaps, than say, on the alpha side or the view side. So how do we square away the issue that quantitative processes, which should work best in risk management, are really bad at dealing with structural, quick market breaks? Is that a false dichotomy that I'm presenting here, or is there actually something to that question? Perhaps, Rowan, I'll throw it to yourself.
Yeah, so I mean, I think it's something that we sort of touched on earlier, that a lot of these risk models again rely on the past and the sort of the relationships from the past continuing. Obviously, risk management is key to any quantitative process in terms of position sizing, levels that you enter in at, and then obviously things like stop loss. And I think part of the problem or elements that sort of caused the quant strategies to struggle last year is they're also crowded. So what happens is a lot of people have got very similar models. They're exploiting similar factors that have worked in the past. And if you run a quantitative process on a data set, you'll come up with the same insights. And then you've got the same risk management principles. So what happens is in crowded trades where they're not working, you get this coordinated cutting of positions. It happened in March last year in the meltdown and the sell-off. And sort of the quantitative strategies did worse. And then I think through the year, as they continue to struggle, as sort of the relationships broke down, so again, the crowded trades created situations where you had these sort of coordinated unwinds. So it becomes self-fulfilling. So I guess that's not in and of itself a problem with the sort of the risk management approach. It's just how the quant strategies sort of have become crowded and apply it. So what we've seen, I think it can add a lot of value to your risk management process, a quantitative approach. The issue is it requires a lot of inputs, which I guess it's only as good as the inputs. So we use something called the Kelly criterion, which allows us to manage risk in terms of sizing trades in absolute terms and relative to each other. but it requires a strong estimate of the probability of achieving the expected returns. And so where that probability changes and that results because market conditions change, you can actually get it quite wrong. So what appeared to be a low risk trade or strategy based on history and based on historic levels and relationships, because those relationships weren't holding, actually was no longer low risk. And you would allocate a lot of capital, but there were a lot of unforeseen risks, unknown risks, the money that's been put into the hands of traders or uninformed investors or investors that use different factors that you do to do valuation, and you hadn't factored that in, you could actually get caught short, so to speak, and that's where it's been very difficult. So again, the process has to be quite dynamic, and your inputs have to sort of evaluate the environment, I think, for it to remain robust. But the tool and the framework remains very sound.
Okay, thanks, Ryan. Nafis, I'll pass it over to your side as well, and potentially you can just add something from the multi-asset setting as well. I know your permit is potentially larger than just the equity side, particularly on the structuring side, and quantitative processes perhaps even lend themselves better to the fixed income and the derivative spaces where we are dealing with quite complicated instruments. So would you add anything, agree, disagree with what Rowan's been saying from the risk management side? What about the effect of regime switches in your models? How do you deal with those?
Yeah, I mean, I definitely agree a lot with what Rowan has sort of highlighted from a risk context perspective in terms of in a live setting and how quickly things change and the process and the tools got to be robust. And we follow similar processes in the multi-asset side. We view volatility as an asset class. And we're quite active in that space, so we bring a lot of asymmetry into the portfolios, and we're constantly pricing at where volatilities could be mispriced, and vol as a function of risk, and so a lot of our portfolios in March that were sort of had exposure to these strategies benefited substantially, and so. We also look at the mispricing of risk, and when it's too rich or whether it's expensive or too cheap, and how to sort of bring that into the portfolios in a cost-effective manner, and obviously using tools of portfolio construction to get a better handle on how to harvest those risk premiums, right? So, it's not to diversify all the risk away because, you want to be compensated for taking on appropriate risk. And so, quantitative processes are quite critical in terms of positioning your portfolios or constructing them in a manner that you're able to get paid appropriately for taking on the right risks. And so we spend a lot of time in the multi-asset portfolios making sure that the diversification element from a risk perspective is well balanced so that when certain outlier events play out, we are well compensated in a portfolio setting.
Okay, thanks very much, Nafis. And what I want to check now is effectively, you mentioned a couple points there about risk premia. Rowan's touched on factors as well. And Nafis, you also mentioned portfolio construction. So two very large topics there, but I think let's stick with our discussion at the moment on risk management and maybe increase its scope to the portfolio construction side, which is clearly, you have to build a portfolio with risk in mind. Now, the question becomes, if my risk models don't have risk of ruin scenarios in them, and I'm following a certain quantitative process where I construct portfolios and they work in normal times, I rely on standard diversification, for example, which we know effectively disappears exactly when we tend to want it and need it most. Correlations tending to 1 is not just a market truism, it's also a market stylized fact. So are there any kind of qualitative overrides on the portfolio construction or risk management side that one should be looking at when trying to look at the quantitative processes? Jean-Pierre, I think I'll turn it to your side now.
I think even before you consider qualitative overlays from a risk perspective, there are strong quantitative tools that you can use as well. So in your example, when correlations go to 1, it's important to do scenario analysis to actually know what your exposures are on a portfolio basis. And quite often you can tag your different positions with a quantitative tag. For instance, which sector is this company in? What's the sensitivity to the rand-dollar exchange rate? What's the sensitivity to a sharp cut in interest rates? And in that way, you can use quantitative tools on your individual positions to work out what your exposures are, not just for normal times, but also what would happen then in stretch scenarios. Similarly, this is quite an equity-focused panel, but if you use fixed income, or let's do something that's more in your line, Emlyn. Let's say you use option strategies. And in normal times, you sell calls, and you would hope most of the times they're covered, but sometimes they are uncovered, depending on where your deltas go. You need to do scenario analysis to know that if you have sold out of the money calls or puts, and share prices move sharply through those strikes, what does your portfolio look like then? What is your gross exposure in that scenario? And I do think that maybe some of the underperformance of a lot of quant strategies over the last year was maybe because of some overconfidence or not doing scenario analysis in terms of properly stressing a portfolio to see what happens in an abnormal market environment. And quant tools lead themselves to more conviction. And you can come to the point where high conviction turns into arrogance or overconfidence. And when quant tools reach that point, and you take on more leverage than what you should, or you have more tail risk than what you should, I think that's where you get into trouble. So yes, there's a lot of quant tools I think one can use from a risk management perspective. And then there are qualitative tools as well. Once again, from an equity-centric perspective, if I am going to sell puts, for instance, I would rather sell puts on companies where the operational performance is strong, and I wouldn't mind being effectively very long those companies if the share price should fall, when I look at the company from a qualitative perspective. And where I might have price risk, or call it market risk, in a certain dislocated market, if I look through the market to the underlying company, and it's a company with low levels of debt and stable revenue generation, I know that it's okay to take on market risk if the look-through operational risk I'm taking is actually below average. And in that way, balance the risks that I'm taking in the portfolio. So I think, as all the panelists have also said, it's using all these tools, qualitative, quantitative, on a portfolio basis, instrument-specific basis, and that's where one gets to the point where, yes, any of these tools in isolation is like a hammer looking for a nail. It's quite blunt. It's going to make mistakes. But if we combine all of them, hopefully between all of these different tools, they make different mistakes. So you cover the blind spots. And in that way, by combining all these tools, you don't have one big blind spot that leads to disaster if a big car crash is in your blind spot periphery. So yes, quantitative and qualitative overlays, I believe, can make significant positive contributions to risk management.
Okay, thanks very much, JP. I think, as everyone's already mentioned, there's nothing like a market crash to focus one's mind on risk management, and that's coming through quite strongly here as well. Ben, I want to touch on something here. Jean-Pierre was talking about exposure mapping, scenario analysis, not just across single assets, but across multi-assets. And he also mentioned, qualitative views on companies. Now, all of those effectively require some kind of idea of a market. When you run scenarios, you have to have some idea of what's possible, the range of possibilities, and perhaps even beyond that, if we look at a COVID type scenario. And this is, I think, where systems come into play a lot, particularly not maybe in the local space, where we have a small set of counters, particularly in the equity side, but in the global setting where you have, tens of thousands of potential instruments. does your reliance on systems for these kind of risk management exercises, scenarios, stress testing, exposure calculations and estimations, how much does your reliance move towards systems, and how much confidence do you effectively outsource to a system?
So obviously, from my background, I'd say you should put 100% confidence in systems because we're great and we can help your processes. But I'll be less sort of the sales pitch. I think, as Jean-Pierre mentioned, I think there's a combination there. I mean, yes, I think you should have a system in place for risk analysis, stress testing, or global conditioning. We acquired a company a couple of years ago called Algorithmics. And as part of as any sort of process, when we acquire a new piece of software, we go out to our community and we speak to them about that specific subject. And it was fairly staggering how many asset managers, so not just hedge funds, but asset managers, when you asked them about their risk process, it reverted back to a very common Microsoft product that everyone uses for their calculations. They didn't have a specific risk product, and it was something that they were just, as Jean-Pierre alluded to, well, the confidence was, it's okay, we can manage that ourselves. I think as COVID and as previous crashes have proven, I believe there are certain areas where you should leave it to the experts or the specialists to get you so far down the process. And then that's where the qualitative effort picks in at that stage and says, okay, we've typed in all our factors. This is the outcome the system says. Do we 100% agree with that? Do we 80% agree with that? And put and make your decisions based on that. But I definitely feel there are massive benefits to using the risk systems there, even if it's just for the back catalogue of conditions they have preloaded that may not be something that in-house companies think to.
Okay, thank you, Ben. I thought I'd have to at least tee you up. The other three had a chance at the beginning to talk their book, so it's only fair. But I agree with you completely. Stress testing is huge, and for a system where you have thousands of degrees of freedom, a simple, I'm happy to say the name, a simple Excel spreadsheet might just not cut it from your data requirements. I just want to go back to the stats and touch particularly, everyone's talked about factors and risk premia. So these are from Hedge News Africa, actually in South Africa. Market neutral and quant median return for 2020 plus 9%. The median return for single manager South African focused hedge funds plus 6%. So a very, very different result in the local space for quant-based funds, market neutral and quant-based funds, in comparison to what we're seeing overseas. At the same time, we know the local industry, at least in the equity space, has been very fundamentally based and fundamentally driven. The trends of factor investing are slowly coming through to South Africa, but there is a large discrepancy between how big factor investing is and quant-based investing is here versus overseas. So my question is the following. Why is there such a discrepancy in the quant alpha modeling techniques that are used elsewhere? Why is it not used in South Africa? And has it actually been to our benefit? Nafees, maybe I'll pass it over to yourself.
Thanks, Emlyn. I think it's a matter of just educating investors. The landscape, I guess, as a function, there's just many more people that are coming out as CAs than statisticians and mathematicians out there. But also, I think in terms of the crowdedness of trades, you're not having that same, and Rowan alluded to this earlier. Overseas, if you look, the hedge fund space is a $3 trillion industry, and $1 trillion of it is quantitative strategies. In South Africa, you've got a 40 billion or 50 billion rand hedge fund industry, and even the unit trust space, and you can count on your fingers how many of them I've got a strong bias to a sort of quantitative approach. So I think there's a tremendous prospect to employ more of this, just from a diversification and an alternative benefit. And it's, in my view, we've got to do a more concerted effort of educating investors and being out there and demonstrating the advantages of embedding a quantitative and systematic rules-based approach, and some of the benefits, particularly in some of our life portfolios, we've enjoyed tremendous alpha generative benefits, and similarly from the guys on this panel. So the evidence is there, and so it's just about how we bring it to market and get more people familiar with the story.
Thanks, Hafiz. I think you've teed Rowan up where you mentioned he made a few comments, and Rowan, you've been talking about factors quite a lot as well. Now, what's your take on factor investing in South Africa? We have our idiosyncrasies, the Resi versus Findi dichotomy, the very concentrated market, a small number of counters, so there's only so many ways to slice and dice on the equity space, and similarly in the bond space and the rest of the asset classes available to South African investors. So does factor investing work in South Africa? If so, if it does work, do we need to make any changes in terms of how it's applied elsewhere in the world?
Yeah, I think you point out that we've got a pretty concentrated capital market, be it in the equity market or the bond market. So to some extent, our investment universe is limited, and I guess these quantitative approaches are more designed for a much broader universe. So say in the States, I mean, you're up to 3,000 stocks that you need to analyze. So the factor-based approach works better there because a team of equity analysts locally, I guess, could cover the top 60 stocks reasonably well, particularly if you've got sector-based analysts, because they are quite idiosyncratic. As you mentioned, resources versus the Findi or the financial sector. We actually break down the JSE into 4 different mega sectors, sort of Chinese internet, resources, local industrials, and then offshore industrials. So, and those stocks and those sectors, I guess, would have different drivers. For example, rand dollar, or the exchange rate of the rand, that would drive some of the sectors indirectly the opposite way. The local equities going down, but obviously your offshore equities going up. So in rand terms, so I think you can use sort of factors as a framework here, but it's more sort of guiding your thoughts and inputs, and it's very sort of stock specific. So that's why it's been, I think, a bit easier here to generate, and investors and traders sort of can pick stocks and really be more of a bottom-up approach as opposed to sort of factor-based investing or quantamental, which would maybe be a little bit more top-down in terms of, looking at, I guess, a broad universe and applying some sort of quantitative process to that. So I think that does, gives the local investors an edge. Yeah, I mean, in terms of taking those lessons elsewhere, I think it's possible that, as you mentioned, the local hedge fund industry in particular is very fundamental based, and maybe what 2020 did show us that sort of it was a year more of fundamentals, and that worked better than, say, a sort of rules-based quantitative approach. So I guess it sort of reiterates that probably the bedrock or the underpin to a good investment process remains fundamentals. You can't get away from that. You can use tools to analyze and sort of filter and everything, but at the end of the idea, it's the sort of underlying businesses that will drive the investment outcomes. And so stock picking, sort of fundamental analysis remains very relevant given different market environments.
Okay, thanks for your thoughts, Rowan. I think we've got about 15 minutes left on the discussion. It's probably time to tackle the elephant in the room, which is machine learning and data science. It is the new buzzword, augmented intelligence. Rowan's already mentioned that as well. Nafis has been mentioning machine learning quite a bit and a big proponent. Again, I will play the role of devil's advocate here. There's a massive focus on the application of data science across all industries, but even strong proponents of quantitative processes globally and locally have suggested that it will have a smaller and slower uptake in the financial market. Maybe we have a very low signal to noise ratio. We have this issue of structural breaks and events like the coronavirus, which nothing can ultimately predict in real time. So, Nafees, what's your view on what kind of role will financial machine learning take, and what will it look like going forward?
Yeah, I think that's a that's a really good question, right? And as you've said, Emlyn, is that we're seeing it in all parts of human society being applied. Natural language processing techniques. I see Bloomberg themselves are massive adopters of various machine learning techniques. With analyzing Twitter feeds and sentiment indicators. You just look in autonomous vehicles. You look in Google, all the FANG stocks, right? There's many components where AI and machine learning is coming up the ranks. Algorithmic trading is a massive area, right? That's evolving at a phenomenal rate, and so there's a large element of AI applications in that space, particularly in the investment management space. The construction of ETFs and thematic based investing, and how do you construct those efficiently and bring those together. There's a lot of machine learning techniques there. You look at people like BlackRock. They've got a huge machine learning team driving a lot of innovation within the space. So I think in terms of the future, there's just so many permutations and applications where this can evolve to. And just thinking and listening to Rowan, you look at our market as well. We've been doing some interesting work in the AI machine learning space, addressing the concentration problem of our index. Right, you take the top 5 stocks; they drive more than 50% of the return in our market. Right, so how do we address that and use quants and machine learning in a clever way in order to address such concentration risks? Because as Rowan's quite rightly pointed out, quants tend to work on law of large numbers, so you need a nice breadth and universe of stocks for the factor-based stuff to work. But I think if you take a deep dive into some of the machine learning techniques, there've been some interesting work done in addressing of the approach of concentration risk. So I think there's a lot of applications and uses to be had for our market in particular in an innovative way.
Okay, thank you, Nafees. Jean-Pierre, I'm going to pass over to yourself now. Just maybe you can expand on that, and particularly Nafees has mentioned a few areas, and there is still the idea that there's a lot of marketing potential for machine learning and AI, although it's debatable whether any fund at the moment is using true artificial intelligence. So what is the reality of its potential? And I'm going to push for an answer. What's the reality of its potential versus the perceived marketing potential that we see in brochures?
No, that's a very good point. And I think the word is potential, as you correctly put it, Emlyn. I don't think anyone has exhibited a successful machine learning application, except perhaps if you think internationally, some like Renaissance Technologies perhaps, which talks more to the microstructure of markets, where you analyze bids and offers and volume coming on screen in a central order book across different execution venues. And machine learning can then automatically pick up certain correlations or relationships between the microstructure of markets relative perhaps to macroeconomics. So, the Bank of Japan decides to raise interest rates, and all of a sudden you see an extra block of Google stock coming on the market. And those types of things you wouldn't necessarily think is rational from a human perspective, or you wouldn't pick up if you have a human-based quant process, because you wouldn't think to look for that correlation. But if you do machine learning, where you effectively feed the machine with all the data all over the world, the machine will pick up certain correlations that you didn't even think about. But that only really works when you incorporate the microstructure of markets in that analysis. And in South Africa, because we only actually have one central order book, and now A2X is challenging the JSE in terms of a second trading venue, but effectively most of the trading happens on the JSE. So you don't have multiple venues to arbitrage, and you don't have these strong correlations that machine learning can show you if you incorporate microstructure data. So it leaves one then, if you do more fundamental data, or let's say all other analysis excluding microstructure, to think about exactly how to implement machine learning. Now, what we've done is historically, like I explained how we use our process, is once again the human application of quants, where we say, we believe, as an example, depreciation has got a strong relationship to the level of property, plant, and equipment of a company. And we start with revenue, and through effectively algorithms and formulas based on accounting principles, we get to the earnings per share at the bottom of the income statement. But what we are now doing is we're busy feeding an Azure-based machine learning cube, if you want to call it that, to say, this is what we think the relationship should be, or this is the areas we are looking for relationships. But Azure Cube, please run some machine learning on this and tell us, maybe there's a strong relationship between the number of non-executive directors on a board and the growth in earnings per share, or the number of, or the turnover rate of CFO to the number of restatements, or all kinds of relationships that we would never think of testing for, but a machine learning cube can do that for us. So yes, we haven't yet used machine learning. I think very few managers have. It is very nice for marketing purposes to say you use machine learning and automation and algorithms. And in our specific case, we are thinking about how to use machine learning, because it's very difficult without applying it to microstructure data to think how machine learning can be applicable to more fundamental data.
Thanks, Jean-Pierre. I can imagine that yourself and the fees would probably have a long time discussing exactly this issue on how to implement, if you could. One point I want to pick up there is you mentioned market microstructure, and directly tied to that, which we've addressed a little bit, is the idea of automated trading, algorithmic trading, reporting of trades. And again, I think, Ben, we're back in your purview here. Have you seen a pickup in terms of the machine learning aspects of the systems that you're providing, and specifically on the order execution and microstructure or trade reporting sides?
It's an interesting subject. I think when you look at it as a marketing angle, it's very much a buzzword, machine learning, AI. It's what a lot of people want to adhere to. It's quite interesting to hear the other members of the panelists talk about it from this specific subject, because with algos and quants, quite a lot of that is almost like machine learning by being brought in-house. You have someone who's writing the algorithms, which then do have a result based on those algorithms. And in effect, machine learning is like taking that to the next level. It's taking that to the area where someone else for Microsoft Azure or someone is entering these algorithms but making them available to the public. So it's an interesting subject. I think one of the reasons why there's maybe a bit of a less uptick at the moment is, from a quant perspective, you're fairly far down the line in regards to what you do yourself already. So taking that to the next level is quite a significant step, and quite a lot of people will still see machine learning as, oh, look, there's a picture beside my Facebook feed, and now I keep getting adverts on Facebook saying I should buy a new lawnmower. It's that sort of level, whereas you yourselves are taking it to a much higher level. It is something that we're seeing crop up a lot, and it's something that we're definitely looking to bring in more house when we get a specific understanding about what it is people want from it, if that makes sense. It's quite a broad subject. In regards to order execution, order management, it then falls back into the how much faith do you have in the black box. Yes, you can do baskets and you can do one click, send all these orders off, but I think there will always be an area of human interaction that managers will want at some stage to say, yes, we do want to do those, rather than rely fully on the black box approach, is my opinion.
Okay, thanks very much, Ben. So it's just to sum up, good for marketing, potentially being used, but still a bit vague on the details of how that's going to be implemented, which I think effectively sums up machine learning, ultimately, in an odd way. Rowan, I think I'm just going to pass over to yourself, just as we end off in the last couple of minutes here. As we, I think it's fitting that you end as well. And again, you've experienced quite a lot of market crashes. You've experienced, I think, a large change in terms of how the market has been viewed. And now we are going into a new future where, there is a lot of potential from machine learning, from data science, from an uptick in South Africa, at least from quant processes that are maybe very endemic to other markets already. So just looking forward and potentially for new entrants in the market, I think particularly, what would you view as the skill set of managers going in? How would those skill sets change? And where would you say is where is the alpha going to come from if I look at it from a quant perspective?
Yeah, it's a good question, because we're seeing so many industries digitize, and I guess the question is, how is investment management going to digitize? Which skills are going to be relevant going forward in this new world where data manipulation is playing a bigger role? So I think it is important that it is incorporated into the overall investment process. So in terms of our existing models, our existing way of thinking about things, how we value things, we look at discounted cash flows to ultimately get to sort of a valuation and intrinsic value, and then look at price and then look for mismatches and the sort of the risks of that outcome being achieved. I think that overall framework remains the same, but we need to think about how digitization is changing the world, obviously, in terms of from a fundamental perspective, different businesses, different business models, the rise of intellectual property, value, intangible assets, all of that. So that's the one side of it, sort of from a fundamental side, but then also incorporating the tools into our investment process and maybe using skills of young individuals that have been trained in this. We sort of I wouldn't say we need a skills refresh, but there's a whole new set of capabilities that's coming on stream, and interesting how we can incorporate those into our investment process. And I think it can add value. So I can see sort of data manipulation, data analysis, data scientists forming part of it, of investment teams. They also may bring a different skill set, a different way of thinking, also a different set of knowledge as part of an input to the investment process. And even if it's then using that to see how market participants are changing their behavior, and you adjust, and even if it's your fundamentals for the short term. So it can add a lot of value tactically. So I think it has quite a big role to play. We're looking at it, how we can incorporate it, and have started sort of, I guess, also exploring it and making sure, it can add value and not sort of distract you and be noise. So it's quite a challenge, but it's quite exciting. And I certainly think it can take us forward and take the entire industry forward.
Thanks very much, Rowan. I think that's a good point to end on. An exciting note, a lot of potential to be unlocked going forward, particularly in the local market, as we've said. To the panelists, thank you very much for all the time. It's been at least to my mind, a very useful, very interesting discussion. I very much enjoyed hearing the different opinions, and I'm sure the viewers have as well. So the viewers, thank you very much for your time, and we hope that you continue to navigate these unique circumstances as well as you can. Thank you very much. Goodbye.
Welcome everybody. Today I'm joined by Stephen Pratt from Prime Asset Managers and Owethu Carter from Tuso Partners. My name is Claire Renska. I'm with Suka and Associates, and we provide investment advice to institutional clients. Prior to joining SNA, I was with 27Four for 8 years, and before that with Riskura as head of their asset manager research department and as a senior consultant. I'm going to let each of the panelists introduce themselves as we chat today about nurturing the next generation of talent within the asset management industry. So, Stephen, I'll kick off with you.
I think I'll start with I've been in the industry for a long time, since the mid-90s, starting off in the UK, and got some global relevance when I was young. Transitioned into managing hedge funds in my own capacity from when I was in my early 30s, and that was in the unregulated manager, unregulated product phase. And have been around the industry, transitioning through regulated manager, regulated product, all the way through now to hosting solutions for alternative managers, long-only managers, various asset classes in both the South African context and the global context, assisting managers to get going. From incubation to licensing to compliance, regulation, and essentially business enablement for asset management solutions, as well as keeping my eye pretty closely on some of the strategies that are within the Prime Asset Managers group, and bringing on new managers into that space all the time to kind of complement a nice succinct menu of product offerings. Currently based in Cobham in Surrey in the UK. But kind of got my feet in both camps, and hasn't changed the way I work with regards to South Africa at all.
So it's mostly in mid-market private equity, where we've been investing as a team in mid-market funds. It's actually been both private equity as well as real assets fund with some real estate, renewable energy, etc. And over the time, we sort of asked ourselves why we weren't seeing new teams coming into market, and particularly it was black fund managers that we weren't seeing in the private equity space. And then we roll forward where we thought if we started an incubation program where we could be the catalytic investor who comes in initially, so that other investors can come in and have more comfort that there has been a DD process that's been done. Because ultimately we found that investors, while they saw talent and new teams, there wasn't a lot of comfort in being the first to make the commitment. So we started an incubation program which focuses, solely on incubating, new teams. New teams being guys that are starting, fund for the first time, or existing team who just haven't as yet got into sustainability.
Great, thanks so much. So we've got a great combination of experience and skills both in alternatives, private equity, and also in the hedge fund space. So, I think, Steve, you mentioned some of the day-to-day issues that you deal with at Prime, including compliance. And the costs of establishing an asset management business have increased significantly in the past, whether it's from the costs of reporting, compliance, but also increasing costs to attract and retain top talent in the industry. And this requires an ever increasing size in terms of assets under management for businesses in order so that they can break even. What do new managers need to make it, and what time frames do they need to look at in terms of establishing their business and raising assets? Steve, I'll start with you.
Yeah, Claire, I think how long have we got? This is one of those things that how long is a piece of string? When you start mentioning time and regulation and compliance and applications and licensing and all those sort of things, it can all be a bit random. I'll go with it's very onerous. It's very onerous, time-consuming, and expensive to get started. So you often get to this scenario where people want to explore the opportunity of managing assets, have the interest in the space, have the capability, and when they just see all the hurdles in front of them, kind of throw in the towel and go, oh, it's too hard, and I haven't raised enough money, and I don't have a firm commitment, so I can't go on risk. And this is so unfortunate for young managers who just really want to get going. On balance, I've had conversations with new managers which are only starting to get established now, and we've had a business relationship for upwards of 3 or 4 years. And they've earned no money yet in this scenario, and I've earned no money from them yet in this scenario. But we've continued the conversation to find a solution. And I think that the key there is building the relationship, the partnership, to tailor a solution where you can sort of go on risk together, knowing that you can trust the process. So I think that's one of the key things, is sort of establishing yourself correctly. And I think, unfortunately, there's this sort of slightly small-minded syndrome in South Africa, especially, that sort of a 50 or 100 million rand is enough to get going. But when you actually unpack what you need to pay away, having the right service providers, having the right compliance structures, and being able to pay away to talented people within that environment, you're certainly not going to make enough fees, especially in the world of fee compression. In the context of offshore, you don't really get looked at from a startup if you're not sort of $30, $50 million pounds. So it's just sort of 10 to 20 times the size. So I think the key there is leveraging partners or groups to take you on that journey, so that you can plug into multiple networks and have that credibility to go to committed capital and say, we're doing this properly. We need a commitment. We're doing this properly, and commit something that, as Owethu said, is sustainable from the start. Otherwise, you're just hobbled. So, fairly long time frame. If you go with partners and you get some commitments, it's possible and doable.
Okay. Owethu, you spoke in your introduction about the role that Tuso Partners has played in terms of being initial investor to try and kickstart businesses. What has been your experience in terms of what managers need to get started?
So initially, getting that first commitment over the line tends to be, quite key. And, it's always a bit of a chicken and egg in that, the managers first need the commitment before they can build out, the FSP setup. And at the same time, the investors want to actually see the individuals, want to see the setup before they can make the investment. So what we found is, if in the beginning they can be light, you've got about 18 months before you have financials for the funds, and within that period, once you show the team is there and can illustrate the experience of the team in actually rolling out a similar strategy or investing in a similar area, it does actually reach the investors, and they become more comfortable in that. Once they have the funds locked in for the 10 years, they've got a very capable team that they can trust to be able to invest this money on their behalf in the blind pool. And then the other one is in terms of setting up, and that's some of the outsourced services, whether it's administration, etc. And what we've tried to do is to speak to service providers and say, here you've got small teams which are growing. They are your future potential large customers, and if you can meet them halfway and help them by bringing prices to a level that meets the size they're at, in the future you'll have a very loyal customer who will also have an understanding that you help them in starting up. So part of what we're doing is, when it comes to administration, legal, etc., we are trying, and we've partnered with some service providers who actually hit it before to say, we understand that these guys are relatively small. They need to be assisted in the very early stages, but they are our potential large customers of tomorrow. So they are getting assistance in that regard. But in terms of raising the quantums over the 18 months, I think investors have also become more open to extending where they haven't reached their target. So you do get fundraising periods being extended for a little while. And within that period, it's being able to show that you've got the pipeline, you've got the team to execute on the pipeline, and also that you've got a robust business plan that will not only be able to provide deals, but will also be able to build a sustainable business so that investors won't only invest in a fund one, but there'll be a fund two as well.
Great, thanks. And you've spoken about trying to get the buy-in of service providers in terms of the future of these businesses, but that takes commitment from investors. And in your experience, do you see investors allocating to early stage managers? We've seen that there've been recent changes to Reg 28 to try and facilitate greater investment into unlisted assets, alternatives, and infrastructure. In particular, hedge funds have been decoupled from private equity in terms of the maximum allocations, but we've also seen that there are very few institutional investors who even have 1 or 2% allocated to alternatives, never mind those reaching the maximum allowable allocations. And there's also been in recent years a lot of very public disinvestments out of the hedge fund space. So, do you think that institutions will get more comfortable in terms of allocating to these asset classes?
Yeah, so I guess we have seen, investors, institutional investors, wanting to back the teams. I think a number of items which they'd like to see first before they have the comfort to actually, sign on that deed of adherence. And some of them includes, the team. the teams are very important. They want to understand that you are not backing individuals, but you're backing a cohesive team. And in that team, it's made of a grouping of individuals whose track record aggregates in this very, investment strategy that they're looking to build out. So you want to understand that, the team members and the team as a whole have actually traveled the whole route in the investment process from, origination to execution to partnering and walking the route with entrepreneurs. And then, a team that can also show that they've done the exits. And then second to that, they also want to spend a lot of time with teams trying to understand, their unique take on the investment strategy. How are they going to, create returns in this environment? And then importantly, investors want to see that it's something they want to see the ESG elements. And if the team can think about those upfront, how are those actually brought into the investment process from the beginning when you're identifying a company, when you're diligencing a company, when you're sitting down with them to decide on investment strategies, and ultimately, how does it go into the business you want to create and what it does in the future, even when you're no longer an investor. And then I think thirdly, speaking to the investors and showing them the pipeline even before you've raised the investment. Because I think importantly, investors want to understand that when they make the commitment, it's not going to be money that sits looking for deals, but you've already done a lot of work in identifying businesses, thinking about the value add you want to have in those businesses, and actually articulating that value add to say to the investors, we're going to take your money, we're going to invest them in X business, and this is what we want to do in terms of making sure that it gets a return for investors, and also touching on all the other goals that investors have, including ESG. So I think investors are really keen on investing in funds, new funds, and the empirical data shows that first-time funds actually outperform. But they just need to be taken through the process to see that we do have a safe pair of hands and we're not making a VC type of investment.
Maybe you can just add to that in terms of your experience and what you've seen in getting investors over those fears that they may have around being an early investor.
Yeah, I think Wetu covered that very eloquently, and I was kind of nodding the whole way through there. I totally agree that there is appetite, especially across alternatives, private equity, and I see private equity deals too, and hedge funds, and variety of alternatives within hedge funds. But I think the key is at the startup phase, the operators really need to know what their strategy is, really need to have done a hell of a lot of work, even pre-startup. And I think that's where Wetu is 100% correct. If you do have your ducks in a row, so to speak, and you might not have all the I's dotted and all the T's crossed as far as regulation and compliance and service providers and all those sort of things, but if you really know your trajectory as far as what you're going to achieve for the ultimate investor and where you're going as a business and how you're going to support that, that goes a hell of a long way to getting your DD process put into place and the right building blocks with the right sort of culture and concept to offer. And I think differentiating yourself with the right culture and concept does tweak investors, and they are interested in that differentiator, and they will allocate to it. But you really do need to have the right building blocks in place, and not think that you're ready to start when you're actually a couple of years away from going, haven't thought about that. Not sure if it's a quiff or a riff or what my audience is. If you're sort of there, you're actually a long way away from having a discussion with an allocator. You need to know what the pipeline of investments are, what your projected returns are, have a clear sort of indication of how you're going to staff up, build capacity, lever your partners, that sort of thing. So I think if you come with that, or you get the support from the likes of Owetu and myself to be able to present yourself in that way, and you can go that journey with partners like that, you've got a high chance of success.
Great, thanks. And in having all the building blocks put together and the pipeline and as you said, getting all their ducks in a row. And for allocators, often there is safety, or perceived safety, should I say, in a big brand name, a big asset manager that's well known. How do smaller firms and new managers overcome the power of these big brands that are out there in the market? And Steve, I'll ask you to start, but one thing that Owetu mentioned was investors looking for more focus on ESG and impact. Is this potentially one area that new managers have an advantage over the incumbents?
This could extend our whole panel discussion if you really get me started on disintermediating big institutions. But I don't think boutique and bespoke managers should apologize for being small or being nimble. I think there's a hell of a lot of power in coming at this industry from this position now. I actually do think that the big institutions are hobbled by decision-making, overhead cost, and various things that we all know. And new talent, new managers, or talent or managers that have come out of institutional businesses can actually start at the right level, including fintech solutions, impact, ESG, all those sort of things. They're more nimble to go and to go and build, look at opportunities and build solutions. I think the key there, though, is you need to have scalability. So you need to have a team or a strategy that can produce scale with regards to what you do in the investment space, as well as how you manage that scale at a business level. And that means partnering with the right service providers, so that you are able to be nimble. You are able to lean on service providers to give you that ability to scale. And I think that sort of due diligence work at an asset management level is key. Look around the market, see who can provide you with the right information, who can provide you with the backbone and the support and the building blocks to give you that scale. If you're the guy with the wherewithal and the know-how, I don't personally believe you need to have a big brand to achieve that scale. I think you can go about your work, develop good returns, be consistent in your messaging without having to have a billboard. That's my view.
Thanks, Owetu.
I couldn't agree more with Steve on just how it helps to be nimble. And the new managers tend to be also very responsive to the needs of investors. And ultimately, I think, in the beginning, it's always a lot of human due diligence. And new managers, if they allow the investors to be able to go through that process of human due diligence by spending the time, it always is an iterative process. And also, opening themselves up to just some of the requirements that the investors can have. And that can only be done through, spending time with the investors. Second is, if they can show that they are actually a safe pair of hands, like a large brand. And the one way to do that is by showing the track record, showing that they have actually participated at the highest level of investment management, going through all of the processes involved, whether it's origination, managing or adding value to the deal, then the name brand itself sort of falls away and it falls to a team which is being backed. And then third is just cohesiveness of the team. Investors really are backing teams. And if the team can spend enough time with the investors so that they can, test out the cohesiveness, they can spend time doing their due diligence and understanding how each of the personalities or each of the skills on the team complement each other. I think that's where they can sort of put themselves on the front foot and make it easier for the investors to make that commitment. But name brand, it shouldn't really be a huge factor if the skills or the track record of the individuals actually show that they're safe within the strategy they're looking to roll out.
Are there any circumstances where investors could possibly have to compromise on return, being early stage investors, and if so, how are they possibly compensated for that in the long term? So a way to maybe in terms of private equity, does it mean the J-curve could be a little bit steeper and the drawdown to start with a little bit more significant, but then the upside at the end of the day better?
In terms of overall through the life of the fund, we think we're in a good position in that there is such a depth of experience within the industry that there isn't a compromise, because you are actually getting that top quality skill to manage the assets, to add value to the businesses. And then when it comes to the J-curve, I think that's where it comes the pipeline that investors talk through with the teams. So ultimately, it does help in that by the time the teams are actually in DD with investors, they can show we've got shovel-ready projects, so that by the time you make a commitment, it's not going to sit waiting for deals. We're going to be able to deploy. And the other good thing with that is that it gives investors a good feel for the type of assets, the type of strategy, the type of value add plans that they're going to have access to through the life of the fund. Quite early on, where they're able to feel, touch, and smell the deals that are going to go into the portfolio. So I think in terms of the availability of skill, we sit in a very fortunate position in that it's in abundance, and so there isn't a compromise when it comes to returns. It's just the teams themselves having a plan, especially at the beginning, so you don't have long drawn out draw down periods. But in general, the returns shouldn't be compromised at all.
And Steve, I mean, obviously for any investor, but particularly institutional investors looking after the savings of members, returns are paramount, and being able to generate good risk adjusted returns is what a retirement fund specifically should be doing. Are there any situations, circumstances where that should be compromised?
Absolutely not. To my mind, investors should never compromise on returns. The only caveat to this is if the early stage investors have an upside option on the success of a venture that they work with a manager, and they take that manager forward for the benefit of everybody concerned in the long term. And that must be, importantly, the investors who ultimately seek the returns, the manager to be able to support the business to continue with consistent returns, and the initial seed investors or incubators that took them on that journey. So if that journey is synchronized and has synergies, then returns can potentially be compromised at the early stage investor if it ultimately ends up in giving them their net result of the returns they desire. But it should never compromise investors that come into to a strategy, in my opinion, or risk-adjusted returns, as you say.
Great, thanks. And for a new business, there's often many challenges that it can face, especially when the team is still small. And I know previously you spoke about being able to be scalable. But investment professionals in a newer, smaller startup manager often have to deal with legal, compliance, operational issues, and then there's also trying to find the balance between the day-to-day operations of the business development and still managing the investments and trying to generate the best returns for investors. So when investing with an early stage or startup manager, what are some of the systems and processes that you can put in place to help mitigate risk, not only from an investment perspective, but also from a business and operational perspective? Because any investor backing an early stage business obviously wants that business to go on and become a successful, sustainable one. Steve, I'll start with you.
Yeah, I think this is probably twofold. There's the sort of the business strategy of the asset manager, which includes the service providers and comfort in quality service providers and the support you've got to be able to lean on that. And we provide that at Prime Asset Managers. It's kind of what we do. We're business enablement and support solutions for asset management across the board. With regards to licensing, administration, risk reporting, get kind of the whole straight through process of what you need from a service provider perspective to be able to effectively manage fund structures, as well as segregated accounts and various other investment opportunities. And then I think the second part, which is key in this discussion, is the sort of mentoring support of experience of going through asset management and what is required, which is what Eloetu's alluded to, is the having your ducks in a row so that you can pass the DD, conviction in message, consistent message, what's written on the tin must be inside the tin, those sort of things. Asset management is a long-term game. If you're starting to get into asset management for a quick buck, you don't build portfolios for a quick buck. You need to have a 10, 15, 20-year view on your strategy. And that's how you get the scale. That's how you get the momentum. And I think sort of bridging the gap between knowing that you need the compliance structures, the regulatory structures, the licensing, all those building blocks in play so that you can actually engage with pension funds or high net worth investors or even retail investors, more importantly, in some form. You need to have those building blocks in place, but you also need to really do what you say and be able to have the ability and support to execute and do what you say. And if you have that at an asset management level, you just have so much more comfort in that is getting taken care of, that you can actually just go manage the assets and make the returns, which ultimately is what the guys come to you with. Is I know how to manage assets. I've got the pipeline. I've got the relationships. I can make the returns. Where do I start? So rather build that system around them and go, you go do your clever stuff, go make the returns, and we'll support you on that. Your chance of success there is really high.
Great, thanks. Owetu?
Yes, on the investment side, I think a robust due diligence process and one which is iterative and enables the investors to really understand, the capacity of the team to be able to roll out their strategy is, a key mitigant. And in the due diligence process, it's also not just taking in what is said by the manager, but also doing referencing, speaking to all portfolio companies to understand what value additions were made by the team members on those boards, what new lines of business they introduced them to, and also if they say they're able to do X for a business, have they actually done it before? And if not, how have they repositioned themselves to be able to do it going forward? And then the other one is for investors to take a very good look at the, who the managers themselves surround themselves with. So in terms of, IC members, who are on those IC, because ultimately they make the investment decisions. So, one needs to do a lot of due diligence on those individuals to understand their backgrounds and how they can actually be accretive in terms of the strategy that is being rolled out. And then the other one is just continuously spending time and in partnering with the manager to understand where they are in terms of their capital deployment, not only, waiting for the annual investor day, but to continuously understand where the manager is and where possible to see if there are ways that as an investor you can assist or, helping by ensuring that, they've got additional support in certain areas, or with the intention of ensuring that the teams can actually focus on the investments themselves and that they have the requisite support to direct their time to that side.
Great, thank you. And maybe just following on from that and in positioning themselves and preparing for due diligence and questions that may come from investors. What are some of the other hurdles that these small asset management businesses can face in the unlisted space? Is it sometimes that it's hard for them to access the deals that they might want to because they get shut out by the bigger players? Perhaps you can talk through some of the other hurdles that you've seen these businesses face.
In the beginning, the key one is actually having the capital, because with entrepreneurs, especially when you spend quite a bit of time with them, they actually want to see the check, because ultimately, if you're not going to be able to acquire the business, they'd like to move on to another buyer. So it is quite important to actually show that you are going to be able to acquire and you are going to be able to partner with them, but you're just finalizing things on the fundraising side. And then the second one, which we see as things coming up, is teams being able to show that they have a proper development plan, including and particularly one which focuses on developing the team. So in the beginning, you find that it's a team of one or two partners, but ultimately, when it grows, you're going to have analysts and associates and everyone else coming on board. Are these the type of individuals that are going to be able to develop those teams? And are these the type of individuals that in the future they'll be able to raise another fund, having been a cohesive team that stayed together throughout the 10 years of a fund? And then quite importantly as well, because they're developing the skills for tomorrow, are these teams diverse themselves? So investors are also spending a lot of time with the full team. So when you're going to speak to the investors, it helps for the teams to actually have everyone on the call so that investors can see that we have that cohesion. They can do that human due diligence. And also they can see that, going forward, there will be further development of these teams. And even with the more junior team members in the next fund, they would have developed to, being partners, etc. So they do want to see how the business is going to build out, and also the development of the team members are quite important.
Thanks. And we know it's been a particularly difficult environment recently for any private equity fund to actually raise sufficient capital to get to a close. Do you think it's even harder for managers raising their first fund than for the more established managers?
So we're finding a lot of interest in investing in new funds. And I think the major difference is while you've had investors who've been keen to invest in first-time funds, the difficulty is always making that initial commitment. So like Tuso tries to do, we like to be the first investor because we also open it up and enable other investors who are keen to back first-time teams but want to have an operational setup in the beginning before they make that commitment. And second, it does help where the teams can have investors who are able to speak to other potential investors for referencing, etc. So we think some of those hurdles, especially in the beginning, which are making it difficult for the first-time teams to raise capital, they're able to be over an initial investor who's able to share DD material, who's able to stand tall with potential investors. So we think the gap in terms of being able to raise capital between the more established and the new is closing. And that's because you do see LPs who are willing to be the first check in the fund.
Thanks. And Steve, maybe if I can ask you, are there some things that the service providers and support structures for funds can do in terms of helping crowd in other investors, particularly in the private equity space? And then also, how do managers look at overcoming the catch-22 of needing capital to raise capital?
Yeah, sure. Where do we start? It's we're building that initiative. I think you have to start bottom up, and you have to make sure, in our context, make sure that you've got all the right building blocks in place from a solutions perspective to offer those solutions to the managers. Once you, at our business level, are confident that the managers are scalable and can pass all the DDs and can do what they need to do, we as a business are then positioned to actually start to be those incubators. On balance, administration businesses haven't done that. And at the core, we're an administration business, but the layers that we built on top of that administration business has become so partner focused at the asset management level that we need to be providing bespoke, tailored asset management solutions for launch, and that includes multiple products. And how do you launch multiple products? Well, you need capital. So if we have the relationship with the managers, we're comfortable that we've brought them into our environment. We should be the ones being able to have the discussion and connect the dots with the allocators. So I think there's a sort of a MES level that needs to be created in the context of our business, which we're working on, to provide those conduits to capital for incubation. And that can be done in a number of ways. It could be done through private equity solutions into more vanilla portfolios, where there's a private equity upside in taking stakes in fledgling asset management businesses, and giving them the critical mass to move forward. The private equity guys still get the return of the underlying more vanilla funds, but they get a private equity upside on the success of the overall business, which makes it sensible from a committed capital perspective, long-term capital. The manager's got confidence that he's got some committed capital for an extended period, so the seed capital remains. That can give you the comfort at a small manager level to really give you the momentum to grow. So I think there's change at play, and there's going to be allocations coming to the spaces that have the access and the networks, which ultimately are businesses like ours. We administer 130 unit trusts that have access to many managers. So we should be providing capital to our partners. We need to build that layer, and these types of businesses need to build that layer, because effectively we do the due diligence on those managers almost on a daily basis. I've looked through to every single portfolio on a daily basis. All our portfolios are daily priced. I sit on investment committees of private equity firms. We know the managers intricately. We can take the allocators directly to the managers. They've had to jump through a hell of a lot of hoops just to get into our environment. So I think that should oil the system for smoother allocation of capital. And that's what we're working on.
Thank you. So if we look at the South African context, I think we've seen that the local listed market has become increasingly concentrated, while in the unlisted space there's probably at this stage more opportunities than there is capital allocated here. Although this could well reverse in the future. We also have more registered general equity unit trusts than we have stocks listed on the JSE. Do we need to be developing and fostering new asset managers, or should we rather be doing a better job at the incumbent asset managers of raising up the next generation of talent and progressing their career paths? Steve, if I can start with you.
I think I'll add in some bias here. I think Loeto and our side of the world should be looked at more vigorously. Private equity and hedge funds and the quality talent that's in that space. I think there should be way more allocations to that, and the oversubscribed equity space does need to be disintermediated, and it will consolidate in some form. It has to. The global opportunities and asset management is changing. It's becoming more and more global, a lot more systems driven, managed by quant models, algorithms. Asset managers can be leaner from a people capacity perspective, from a fintech perspective. They don't necessarily have to be fundamentally driven to generate returns, which are on balance many of the equity professionals, that's their sort of game plan. We've got electronic engineers developing asset management solutions, and they're producing good returns, and they're doing it in a way that it's through regulated product. So I think that sort of thing, the asset management space is changing. As long as you've got functioning marketplaces and you've got clever people developing alternative solutions, I certainly believe that there's a place there for talenting, for talent searching and harnessing those ideas and not being scared of the alternatives. I think alternatives can develop outsized returns, and if you give those guys a chance, there's definitely absolute returns to be generated there.
Loeto?
Yeah, I think we do need a little bit of both. We do need to see new teams coming to market, the formation of new managers, and at the same time we're seeing how important it is that human due diligence element and investors are consistently wanting to understand how the teams themselves are going to be developing the individuals that work alongside themselves. So if we can do a bit of both, I think we both, opening up, the market, increasing the investable universe, and at the same time, we ensure that we have a healthy pipeline of new investment professionals who, in the future, themselves will be the ones starting new firms. So I think we're going to see a little bit of both. And from the investor end, they'll want to be doing a lot more due diligence on this, and they'll want to do a lot more monitoring on this. So I think we'll see a little bit of both going forward.
Owethu and Steve, thank you very much for your insights, both for allocators and for new managers into nurturing the next talent of asset managers. Thank you.
Hi everyone, my name is Luciso Pukhele. I head up the fixed income and equity prime service operations. The prime service team is responsible for making sure your trade settles correctly, your valuation is correct on a daily basis, and perhaps you'd like to meet the team. This is the fantastic team that looks after your portfolio on a daily basis, and I hope everyone has a great year ahead.
Thank you for watching this year's Hedge News Africa Symposium. The content will remain live on the site for 12 months for you to work through in your own time. A big thank you to all our speakers and panelists for working with us to deliver a high-quality agenda. And thank you to all our sponsors for partnering with us to produce timely, world-class content for our industry in this year of Business Unusual.